Welcome to Griffonomics. Today, we're diving into MDA space, trading under the ticker MDA.
Yeah, and this is, it's really a masterclass in a complete corporate metamorphosis.
It totally is. Because, for decades, if you brought up this company, the immediate association was just legacy robotics.
Right, the Canada.
Exactly, the Canadarm on the International Space Station. Like, that was their whole identity. They were this bespoke component manufacturer.
Building these highly specialized, artisanal pieces of hardware over, half a decade.
Yeah, you build one beautiful arm, you bolt it to a shuttle, the world collapses, and then you just start all over again.
But the sources we have for mid-2026 paint an entirely different picture, don't they?
Oh, completely different.
Okay.
They're executing this deliberate, incredibly aggressive, and highly profitable turnaround.
They've just completely abandoned that artisanal component model.
They really have. They've pivoted into being a vertically integrated, full-scale prime systems contractor. Basically, they're building the heavy machinery for the new orbital economy.
And the shift in their operational DNA is just staggering when you really dig into the mechanics of it.
Right.
We are no longer talking about a company that just waits around for a massive governmental science project to get funded once a decade.
Yeah, they looked at the macro environment and, they realized the future of low Earth orbit, or AEO, isn't about single billion-dollar exquisite satellites anymore.
Exactly. It's about massive constellation moats. They're leveraging this really unique, high-volume production assembly line to secure multi-billion-dollar contracts.
Contracts that require hundreds of satellites, right?
Hundreds of them, yeah. But as we unpack the financial transcripts and the corporate presentations for this deep dive, there's a central structural tension.
And that's something you, the listener, really need to keep at the forefront of your mind as we go through this.
Because you can't just snap your fingers and suddenly become a mass production prime contractor.
Right. You have to actually build the machine that builds the machine.
Exactly. And that aggressive capital deployment strategy, it creates a squeeze. It temporarily compresses their short-term free cash flow.
Because they're pouring immense amounts of capital into physical infrastructure, right?
Yeah, all while simultaneously trying to stand up this highly recurring, vertically integrated global geospatial data engine.
They're essentially rebuilding the airplane while it's in a steep climb.
Which means we're watching this massive collision between legacy aerospace timelines and software-era scaling expectations.
It's wild. So if you're examining space infrastructure right now, whether your lens is investment strategy, global defense posturing, or, just an obsession with orbital mechanics, MDA is kind of the ultimate pick and shovel play.
They absolutely are. They aren't trying to be the consumer-facing telecom provider.
Right. They're building the unassailable back-end infrastructure, the stuff that makes those telecom networks and sovereign defense networks actually function in a contested orbital environment.
So let's ground this thesis in the actual numbers, right?
Yeah, let's do that. Because the operational revenue and profitability audit from their first quarter of 2026 is what initially jumped out at me from the stack of sources.
It's pretty eye-opening. You don't often see a legacy industrial company throw up software-like growth metrics without, completely destroying their margins in the process.
No, you don't. The Q1 2026 print showed top-line revenue expanding by a massive 32.2% year over year.
Which is huge.
Right. They hit 464.1 million Canadian dollars in a single quarter.
The top-line acceleration is impressive, sure, but the underlying profitability is where the execution really shines here.
Yeah, they delivered a solid Adjusted EBITDA margin of 19.5%.
Translating to 90.6 million Canadian dollars.
Which is nuts. Because when a heavy manufacturing business scales its top line by over 30%, the expectation model by most analysts is a severe margin compression.
Exactly. You typically have to overhire, you run into supply chain bottlenecks, you pay premiums for expedited shipping, and your operational inefficiencies just multiply.
But MDA managed to hold the line at nearly 20%.
Right. And I want to contextualize that 32% Q1 growth against what they did in the previous fiscal year, because the velocity here is compounding.
Oh, yeah. If we look at the baseline for full year 2025, they printed a record revenue performance of 1.63 billion Canadian dollars.
Which was a 51% year-over-year growth rate from 2024.
Yeah, generating 323.9 million in Adjusted EBITDA. So they've been running at a dead sprint for over 18 months now.
And that steady backlog conversion is directly driving the bottom line. Their adjusted diluted earnings per share shot up 27% to 38 cents per share in Q1.
which beat the street's expectations by 6 cents, right?
It did,
Hmm.
and it proves that the revenue growth isn't just some mirage built on loss-leading contracts designed to pump up the backlog.
Because in the aerospace sector, it's remarkably easy to win a massive government contract if you intentionally underbid your competitors.
Oh, absolutely. But then you end up bleeding cash for 5 years trying to actually deliver it.
Right. But MDA's EPS beat demonstrates that they're actually extracting the modeled margins out of their backlog.
The execution on the factory floor is basically matching the promises made in the boardroom.
Okay, but this is where the structural tension you mentioned earlier kind of rears its head.
Okay, go ahead.
And I have to push back a bit on the idea that this balance sheet is perfectly bulletproof right now.
Fair enough.
If top-line revenues are exploding by 30 to 50%, and they're holding a 19.5% margin, why are they bleeding cash at the operating level?
Ah, I see where you're going.
Yeah, the sources show they reported a negative operating cash flow of $28 million in Q1.
Right.
That's a pretty glaring disconnect. I mean, you can't really claim to be a highly profitable compounding machine while simultaneously reporting negative operating cash flow, can you?
Well, the disconnect is entirely rooted in their CapEx cycle.
Okay, explain that.
To understand that negative $28 million figure, you have to look further down the cash flow statement to their capital expenditures.
Which jumped to $88 million in Q1.
Exactly. This is an operational burn. They aren't losing money because it costs them more to build a satellite than they sell it for.
Right. So where's that cash going?
They are aggressively deploying strategic capital to finalize the physical infrastructure they actually need to handle this newly won backlog.
Okay, so it's the classic difference between an income statement and a cash flow statement.
Precisely. The income statement says they're wildly profitable on the goods they delivered this quarter.
While the cash flow statement shows they are writing massive upfront checks to, pour concrete, install automated robotic assembly arms, and outfit high-grade clean rooms for the future.
And in the context of heavy aerospace, that CapEx is front-loaded and totally inescapable.
Because if your backlog suddenly demands that you produce 400 satellites a year instead of 4, you can't just run a second shift in your existing facility.
Right. You need a completely reimagined physical footprint.
So that negative operating cash flow is really just the mathematical reflection of a company caught in the transitional friction between its legacy business model and its future mass production reality.
That's exactly it, which makes the events of September 2025 so fascinating.
Oh man, yeah. Just as they were pouring all this capital into their production capabilities, relying heavily on a massive commercial backlog, they suffered what looked like a catastrophic blow.
Potentially company ending from the outside.
The EchoStar cancellation. Let's unpack the EchoStar situation because it reveals a whole lot about the fragility of commercial space contracts.
But also how MDA's legal structuring completely saved them.
Right. So the EchoStar contract was supposed to be the foundational pillar of their commercial pivot.
MDA had secured this massive agreement to act as the prime contractor for 100 MDA Aurora direct-to-device satellites.
The base contract was valued at 1.8 billion Canadian dollars, or roughly 1.3 billion US dollars.
And if you factored in the follow-on options, the speculative pipeline value was stretching toward 3.5 billion CAD. It was monumental.
And then EchoStar issued a termination for convenience, just like that.
The contract was completely dissolved.
A $1.8 billion hole blown in the backlog overnight. I mean, normally in the defense or aerospace sector, a termination of that magnitude happens because the prime contractor fundamentally failed.
Right, like the technology didn't pass a critical review, or Lockheed Martin swooped in and underbid them by 20%.
Exactly. But the forensic analysis of this termination shows it had absolutely nothing to do with MDA's engineering or pricing.
No, it was entirely driven by macroeconomic regulatory maneuvering.
Yeah, EchoStar was embroiled in a massive dispute with the FCC in the United States over wireless spectrum licenses.
EchoStar held these incredibly valuable assets, specifically the AWS-4 and H-block spectrums.
And the FCC operates under a strict use it or lose it mandate.
Right. You cannot sit on vital telecommunications real estate indefinitely without actually deploying a network.
So SpaceX recognized this vulnerability and began aggressively lobbying the FTC,
pointing out EchoStar's failure to utilize the spectrum. It was basically a targeted assassination of EchoStar's regulatory standing.
Wow. Facing the very real threat of having those spectrum assets stripped by the FCC, EchoStar executed a complete corporate pivot.
They realized they didn't have the time or the capital to build out an independent, direct-to-device satellite network from scratch.
So they capitulated. They sold those spectrum assets directly to SpaceX for an astonishing $17 billion.
And the immediate downstream casualty of that $17 billion transaction was MDA.
Because SpaceX is arguably the most fiercely vertically integrated space manufacturer in existence.
Exactly. They build their entire Starlink constellation in-house. They had absolutely zero use for a $1.8 billion manufacturing contract with an external Canadian prime.
So the MDA contract was rendered arbitrarily obsolete the moment the ink dried on the SpaceX EchoStar deal.
It really highlights the extreme concentration risk in these mega constellation contracts.
It does. You can have the best engineering in the world, you can be perfectly on schedule, and you can still lose your flagship contract because your client got outmaneuvered in a Washington regulatory battle.
But here is the multi-billion-dollar paradox.
Okay, lay it on me.
If I'm an investor modeling MDA's cash flows, I am assuming that a sudden $1.8 billion termination means massive write-offs.
Oh, for sure. You're assuming half-built chassis sitting in warehouses, unrecoverable engineering hours, just a devastating hit to the Q4 earnings.
Right. So how did they walk away from this without a crater in their balance sheet?
This is where their aggressive, forward-looking legal structuring forms a secondary moat around the business.
Yeah, the contract was embedded with a highly punitive termination for convenience clause.
MDA's legal team basically ensured that the financial guidance was insulated from this exact kind of single customer bad debt exposure.
Because EchoStar canceled without cause, meaning the termination wasn't triggered by a failure on MDA's part, the contractual mechanisms legally forced EchoStar to compensate MDA in full.
In full, for all accumulated development outlays, all forward supplier liabilities, and substantial termination fees.
They essentially built a poison pill into the cancellation terms. Every single engineering hour, every piece of procured titanium, every supplier deposit was fully reimbursed.
They didn't take a single cent of write-down on their baseline profit numbers. They were made entirely whole on the sunk costs.
They were made whole in the past, sure, but it still left a gaping $1.8 billion void in the future pipeline.
Yeah, that kind of sudden vacuum usually forces a company to initiate layoffs or scale back factory construction.
Which brings us to the replenishment paradox.
Right, because how do you replace $1.8 billion in commercial telecommunications backlog when there are only a handful of companies on Earth capable of funding a constellation of that size?
You pivot back to the sovereign balance sheets.
In June 2026, almost perfectly timed to erase the EchoStar anxiety, MDA secured a monumental $688 million Canadian dollar contract with the Canadian Space Agency.
The CSA contract was just a masterstroke in backlog replenishment.
MDA was selected as the prime contractor to design, assemble, and commission a next-generation synthetic aperture radar, or SAR satellite system.
And this new hardware is designed to reinforce the existing RadarSat constellation mission. It utilizes MDA's proprietary fourth-generation Chorus architecture.
The distinction between standard optical satellites and synthetic aperture radar is crucial here.
It really is, for understanding why sovereign governments are willing to pay nearly $700 million for this capability.
Because if a government relies on optical satellites, which are essentially just giant, highly complex digital cameras, their intelligence gathering is totally at the mercy of the weather.
Right. If there's cloud cover over a contested border, or if it's nighttime, an optical satellite is functionally useless. It's blind half the time.
But SAR technology fundamentally alters the physics of orbital surveillance.
Instead of passively capturing reflected sunlight, a SAR satellite actively transmits microwave pulses down to the Earth's surface and measures the backscattered signals.
And because microwaves operate at a much longer wavelength than visible light, they penetrate right through cloud cover, dense smoke from wildfires, heavy rain systems, and total darkness.
It gives a government uninterrupted 247 all-weather surveillance.
Like if you need to monitor ice flows in the high Arctic or track illegal maritime fishing vessels operating under the cover of a storm.
Or monitor ground-level troop movements through dense cloud cover, SAR is really the only tool that works. It is the ultimate persistent eye in the sky.
And by securing that $688 million SAR contract, MDA immediately injected high-margin, ultra-sticky sovereign government revenue back into the void left by EchoStar.
Because government defense and intelligence contracts don't get terminated because of a sudden FCC spectrum dispute.
No, they are backed by national security imperatives.
This replenishment proved that MDA's underlying business model balancing volatile commercial mega-constellations with highly secure government defense work is structurally resilient against macroeconomic shocks.
It proved they could take a punch that would have bankrupted a smaller aerospace firm and just brush it off.
Yeah.
But let's look at the actual physical hardware that allows them to execute on both the commercial and the sovereign side.
Right, the factory.
We keep mentioning this massive CapEx spend. Where is that $88 million actually going?
It brings us to the operational heart of the company, the Constellation Manufacturing and Mass Throughput Engine.
And the output of that engine is clearly visible in the segmental breakdown. If you isolate their core satellite systems division, it ballooned by 41% year-over-year in Q1.
Reaching 313.1 million Canadian dollars.
That single division is acting as the primary operational scale engine for the entire enterprise.
It's where the massive backlog is actually converted into physical hardware and recognized revenue.
And the sheer volume of hardware they are moving is unprecedented for a company of this size.
This 41% growth is being driven by what the transcripts refer to as their anchor constellations.
They aren't building science projects anymore. They are building orbital infrastructure.
And the heaviest anchor is the Telesat Lightspeed program.
MDA is the exclusive prime contractor for Telesat's entire low Earth orbit broadband network. We are talking about the mass manufacture of an initial matrix of 198 software-defined satellites.
To contextualize that, building 198 satellites used to be a decade-long endeavor for the entire global aerospace industry combined.
Wow.
And MDA is doing it for a single client. And the sources specifically highlight that the Lightspeed program has officially passed its Critical Design Review, or CDR, pacing ahead of schedule.
The CDR is the ultimate engineering crucible. It's the exact moment where theoretical physics and CAD models are forced to become physical, manufacturable reality.
Right, the blueprints are frozen, the client looks at the final schematic, signs off on the exact power thresholds, the thermal tolerances, the structural integrity,
And agrees that the design meets the mission requirements. Once you pass CDR, the engineering risk just plummets.
You stop iterating, you stop tinkering with the payload, and you turn the assembly line on.
It shifts the entire project from a highly volatile research and development phase into an execution and manufacturing phase.
And Telesat isn't their only anchor. They are concurrently executing a hard contract to deliver 50-plus next-generation direct-to-device LEO satellites for the global star network.
When you stack 198 Telesat units on top of 50-plus Global Star units, you realize that traditional aerospace manufacturing techniques are entirely obsolete here.
You cannot have a team of highly credentialed engineers slowly walking around a single static chassis with torque wrenches for 6 months.
You need an entirely different paradigm. You need an architecture that looks less like a bespoke defense contractor and more like the automated high-throughput lines you see at a modern automotive plant.
Or a semiconductor fabrication facility. You have to standardize the parts, modularize the components, and utilize robotics to move the work to the worker.
Which is exactly what the $88 million in Q1 CapEx is funding.
MDA has opened an immense 185,000 square foot manufacturing facility in Montreal.
This facility is the physical manifestation of their prime contractor pivot.
It utilizes modular, automated assembly lines that allow MDA to output an astonishing delivery schedule of 2 satellites per day.
2 satellites a day. That is a theoretical maximum throughput of nearly 400 satellites a year.
Which completely breaks the traditional cost curve of aerospace manufacturing.
When you are churning out 2 highly complex orbital platforms every 24 hours, your unit economics undergo a radical transformation.
You achieve massive economies of scale on your raw materials. You aren't buying titanium and carbon fiber for one chassis, you are buying it by the ton.
And your labor hours per unit absolutely plummet because the automated systems are handling the repetitive integration tasks.
It allows MDA to offer these constellation operators a price per satellite that legacy artisanal manufacturers simply cannot compete with.
The fixed costs of the Montreal facility are just amortized over hundreds of units.
And the sources note that limited deliveries from this new facility are launching late this year, with a trajectory leading to maximum factory ramp-up throughout the entirety of full year 2027.
But the genius of the Montreal facility isn't just the speed at which they can bolt metal together.
No, the most critical competitive moat they have built is hidden deep inside their supply chain strategy.
They are executing an aggressive strategy of vertical integration. They aren't just buying off-the-shelf components from third-party vendors and assembling them like a giant Lego set.
Right, they are insourcing the absolute most complex, high-value, and difficult-to-manufacture components on the satellite.
The crown jewel of this vertical integration strategy is their Prime 2.0 digital beamforming application-specific integrated circuit, or ASIC, chips.
MDA realized that if you rely on a third-party semiconductor fab to design and deliver the actual brains of your software-defined satellite, you don't control your own destiny.
So they acquired a company called Satisfy, effectively buying an entire in-house space-grade chip department.
They are now actively routing these Prime 2.0 ASIC chips straight from their own silicon division directly onto the assembly floor in Montreal.
The physics and engineering required to pull this off are monumental. Let's break down why an aerospace company needs its own custom silicon.
And specifically, what digital beamforming actually does.
Yeah, if you look at a legacy telecommunications satellite from 20 years ago, it used mechanical steering.
It had a massive parabolic dish, and if the operator wanted to shift the signal coverage from, say, New York to Chicago, they literally had to activate a physical motor in space to slowly turn the dish.
And mechanical steering introduces a cascade of vulnerabilities. Motors have moving parts, which means they experience physical wear and tear.
In the vacuum of space, experiencing wild temperature swings, moving parts eventually fail.
Furthermore, mechanical steering is incredibly slow, and a single dish can only point its central beam at one geographic area at a time.
But digital beamforming entirely eliminates the physical movement.
It utilizes highly advanced, electronically steered phased antenna arrays.
Instead of a moving dish, you have a flat panel covered in thousands of tiny individual antenna elements.
Right. And by infinitesimally delaying the timing of the radio signals emitted by each specific element, the intersecting electromagnetic waves create a highly focused beam of energy that can be steered instantly, purely through complex mathematics.
You can shift the signal from New York to Chicago in a microsecond.
You can split the beam to serve thousands of individual smartphones simultaneously, which is the entire technological premise of the direct-to-device cellular connectivity market.
But executing that level of highly complex real-time calculus requires an immense amount of processing power.
And you can't just slap a standard commercial computer chip onto a satellite and expect to work up there.
Space is a highly irradiated environment. A standard chip will get hit by a stray cosmic ray, experience a single event upset, and instantly fry or reboot.
You need custom silicon that is aggressively radiation hardened, heavily shielded, and optimized to operate under extreme thermal constraints where heat cannot dissipate through the air.
By designing and manufacturing that Prime 2.0 ASIC chip in-house, MDA captures the margin on the single most expensive and critical component of the payload.
They insulate themselves from the massive global supply shocks that routinely cripple the semiconductor industry.
They aren't waiting in line behind Apple and NVIDIA at a third-party foundry. They control the entire technological stack, from the silicon wafer up to the final orbital insertion.
It's the ultimate expression of control. They own the factory, they own the automated robotics building the chassis, and they own the custom silicon directing the signals.
But, as powerful as that Montreal engine is, it is primarily focused on the commercial telecom and civilian agency markets.
Right. And if you want to achieve true hyperscale growth in the aerospace sector, you cannot rely solely on commercial broadband.
You must breach the walls of sovereign defense budgets.
The commercial market provides the volume, sure, but the sovereign defense market provides the impenetrable margin and the structural stability.
Defense contracts are the ultimate economic bedrock.
However, MDA faced a massive structural hurdle here. They are a Canadian company.
And the global defense market is fiercely, unapologetically nationalistic.
Exactly. The French military wants to buy orbital assets from French corporations. The United States Pentagon insists on buying from American prime contractors.
If you are a Canadian aerospace firm, you are fundamentally locked out of the most lucrative sovereign budgets on the planet.
You can't just submit a better engineering proposal and expect to win a highly classified U.S. Space Force contract. The bureaucratic walls will block you before the engineers even see your blueprints.
MDA's executive team understood this reality perfectly. They realized that organic growth into these markets was functionally impossible.
So they initiated an incredibly aggressive, highly targeted, cross-border acquisition spree designed to forcibly ingest these sovereign defense markets.
They basically decided to buy the required passports.
Yeah. The first, and arguably the most vital, acquisition targeted the American defense market.
In late 2026, MDA executed an all-cash $620 million acquisition of Blue Canyon Technologies, or BCT.
Purchasing it directly from RTX's Raytheon division. $620 million in pure cash for a relatively small satellite component manufacturer.
Right.
Why pay that premium?
Because BCT is the ultimate U.S. gateway.
Okay, tell me more.
On a purely physical level, the acquisition grants MDA an immediate 140,000 square feet of specialized U.S.-based manufacturing footprint situated in the highly strategic aerospace corridors of Denver and Boulder, Colorado.
And BCT is not some speculative startup. They are a mature, profitable entity with a proven flight heritage, having successfully launched over 85 spacecraft.
But the physical factory in Colorado is nice, sure, but that isn't worth $620 million.
No, the true value of BCT lies entirely within its bureaucratic classification.
BCT provides MDA with the holy grail of American defense contracting.
Existing facility security clearances and a fully established FOCI mitigated structure.
Right. FOCI stands for Foreign Ownership, Control, or Influence.
It is the absolute bedrock of the Pentagon's supply chain security apparatus.
The U.S. Department of Defense operates under the strict mandate that no foreign entity, even a highly allied nation like Canada, can exert operational control or undue influence over a company executing classified, top-secret national security contracts.
So if a foreign entity buys a U.S. defense contractor, the DoD will immediately strip the company of its security clearances, rendering the acquisition totally worthless.
To prevent this, the acquiring company must establish a FOCI mitigation agreement,
which usually involves setting up a complex proxy board or a special security agreement, placing American citizens with high-level clearances in charge of the subsidiary's daily operations.
completely insulating them from the foreign parent company's executive team.
It's an incredibly arduous, multi-year legal nightmare to establish a FOCI mitigated structure from scratch.
But by acquiring BCT, which was already deeply embedded within the Raytheon defense ecosystem, MDA bought a pre-cleared, fully functional FOCI firewall.
They instantly bypass the invisible wall.
This allows MDA to take that incredible, low-cost, automated mass production blueprint they perfected in Montreal, digitally transfer those manufacturing processes across the border.
Replicate the assembly lines inside the highly secure, cleared facilities in Colorado and begin manufacturing custom, localized satellite variants directly for the U.S. military.
It fundamentally changes their addressable market. They aren't just selling components to American primes anymore. They can bid as the prime contractor themselves.
The acquisition immediately grants MDA direct access to the proposed $55 billion U.S. Space Force budget.
It adds an estimated $3.5 billion to their immediate addressable opportunity pipeline.
It's a brilliant, calculated backdoor into the most well-funded, technologically aggressive military procurement system in human history.
But they didn't stop with the United States.
No, they didn't. Just weeks after securing the BCT deal, they executed a massive European maneuver.
They pivoted from American hardware manufacturing to European artificial intelligence and data analytics.
They orchestrated a massive takeover of Collecte localization satellites, or CLS.
The scale of the CLS transaction really underscores the aggressiveness of MDA's M&A strategy.
This was a 567 million euro transaction, roughly 920 million Canadian dollars in cash.
MDA purchased a dominant 70% majority stake in CLS directly from CNES, which is essentially the French National Space Agency, and other minority stakeholders.
Nearly $1 billion Canadian dollars for a French data company. If BCT was about securing a U.S. hardware footprint, what exactly does CLS provide that warrants $1 billion valuation?
CLS engineers a complete transformation of MDA's revenue profile.
Okay, how so?
Prior to this acquisition, MDA was fundamentally a hardware manufacturer. They built incredibly advanced physical assets, launched them into orbit, collected the milestone payments, and largely moved on to the next build.
Right.
CLS operates at the complete opposite end of the value chain. They are the masters of AI-driven, ground-based data analytics.
They don't build the satellite. They ingest the massive, chaotic stream of data the satellite beams down, and they use machine learning to extract actionable intelligence.
CLS operates an expansive network of 14,000 clients across 150 countries.
And their primary domain is maritime intelligence. The sources indicate that CLS processes an astonishing 30 million individual maritime positions every single day.
To put that into perspective, CLS effectively monitors 100% of global maritime traffic.
Wow. They track the transponders of massive cargo vessels, they monitor environmental pollution like oil spills, and crucially, they utilize advanced analytics to identify dark vessels.
Right, ships that have illegally turned off their transponders to engage in illegal fishing, smuggling, or covert military operations.
The strategic synergy here is almost unfair. By integrating CLS, MDA instantly doubles its recurring software as a service, or SaaS, revenue stream.
They evolve overnight from a hardware builder into a 247 global geointelligence data provider.
You use the Montreal factory to mass produce a constellation of SAR satellites. You launch them to monitor the oceans. And instead of just selling the satellites to a government, you retain ownership of the data.
You feed that raw radar data into the CLS artificial intelligence engine in France, and you sell the resulting intelligence on a monthly SaaS subscription.
To thousands of maritime security agencies, environmental groups, and shipping conglomerates globally.
It is the holy grail of modern aerospace economics. You combine the massive, high barrier to entry competitive moat of advanced orbital hardware manufacturing with the infinitely scalable, high-margin, recurring revenue dynamics of a software-as-a-service data platform.
It completely insulates them from the cyclical nature of hardware procurement.
And the ingestion of sovereign defense capabilities extends beyond just data analytics.
Right. The commercial hardware they are producing is being actively militarized in ways that fundamentally alter the strategic balance of power in orbit.
The sources highlight a specific program that perfectly illustrates this kinetic defense element. MDA Midnight.
MDA Midnight represents the active defensive militarization of their commercial platforms.
For decades, space was considered a benign sanctuary. Satellites were completely undefended.
But as the domain becomes highly contested, sovereign defense agencies recognize that simply launching a billion-dollar communications satellite and hoping no one tampers with it is no longer a viable strategy.
They require the capability to actively defend their orbital infrastructure against adversarial interference.
If a hostile nation deploys a covert inspector satellite to approach your classified military communications node, intent on blinding its optics with a laser, jamming its signals, or physically grappling it to alter its orbit, you need a response mechanism.
You need a guard dog.
And that is what Midnight provides.
The brilliance of the Midnight program is its economic efficiency. Instead of spending 5 years and $2 billion designing a bespoke, highly classified military space control vehicle from scratch, MDA leverages its commercial scale.
They take a standard, highly reliable Aurora satellite bus directly off the high-volume automated assembly line in Montreal.
They pull a commercial chassis that benefits from all the economies of scale we discussed earlier.
But instead of outfitting it with a standard telecommunications payload, they mate that commercial bus with the advanced rendezvous robotics and proximity operations software derived from the MDA Skymaker program.
Skymaker is the direct commercial descendant of the legendary Canadarm technology.
It encapsulates decades of institutional knowledge regarding how to safely maneuver, grapple, and interact with uncooperative objects in the vacuum of space.
By fusing a mass-produced, highly maneuverable satellite bus with world-class robotic inspection and electronic countermeasures technology, MDA creates a highly capable space domain awareness and control platform.
It can actively patrol the orbital vicinity of high-value assets. It can perform close proximity visual inspections of unidentified foreign satellites, deploy electronic countermeasures to disrupt jamming attempts, and physically reposition itself to block the trajectory of an incoming threat.
And because they're utilizing a commercial bus pulled from an active assembly line, they can produce these defensive platforms at a speed and price point that completely disrupts the legacy defense procurement models.
CEO Mike Greenlee explicitly highlighted this advantage.
Traditional defense primes might possess the engineering capability to build a space control craft, but their bespoke manufacturing processes require them to hand-build each unit one by one, resulting in exorbitant costs and massive delivery delays.
MDA's unique ability to seamlessly convert a high-volume commercial asset into an active orbital defense platform provides them with an insurmountable competitive advantage in the rapidly expanding space domain awareness market.
The strategic puzzle pieces are just incredible.
You have the sovereign SAR surveillance contract in Canada, the U.S. Space Force Gateway secured through BCT in Colorado, the global maritime AI engine operating via CLS in France, and automated orbital guard dogs rolling off the line in Montreal.
It is an incredibly aggressive, perfectly executed global expansion.
But all of this ambition slams headfirst into the reality of corporate finance.
Yes.
We are talking about $620 million US here, 920 million Canadian dollars there, plus the $88 million a quarter being poured into the factory.
Which leads us directly to the most critical question of this entire deep dive: capital structure and share dilution mechanics.
Because the operational strategy is brilliant, but without a bulletproof capital allocation framework, aggressive M&A of this magnitude will violently destroy a company's balance sheet.
Buying your way into the U.S. Space Force and the French data sector requires billions of dollars of liquid capital.
If you simply walk into a syndicate of global banks and demand $1.5 billion in corporate debt to fund these acquisitions, you're going to saddle the enterprise with crushing interest payments that will completely obliterate your free cash flow for the next decade.
Your leverage ratios will explode, your credit rating will get downgraded to junk status, and the very operational turnaround you were trying to execute will be suffocated by debt servicing costs.
So what did they do? MDA's chief financial officer understood that leveraging the balance sheet to fund this cross-border blitz was a path to ruin, especially in a macroeconomic environment characterized by elevated interest rates.
To preserve their investment-grade credit profile, MDA executed a massive, highly orchestrated primary equity dilution phase.
They bypassed the debt markets entirely and went directly to the public equity markets to raise the necessary cash.
The transcripts detail the exact mechanics here. They successfully raised nearly $1.1 billion in highly liquid equity capital within a tightly compressed 12-month window.
And they didn't just drip these shares into the open market and pray the price held up.
No, they executed an upsized bought deal common stock offering, perfectly priced at $35.60 per share.
The bought deal mechanism is crucial here. By having the underwriting investment banks commit to purchasing the entire block of newly issued shares up front, at a guaranteed set price, MDA completely transferred the market execution risk to the syndicating banks.
They ensured that the massive cash of liquid capital required to fund the BCT and CLS cash purchase prices was locked in and immediately available, completely insulating the M&A timeline from broader stock market volatility.
It secures the war chest instantly. But as an analyst looking at this, I have to challenge the long-term impact of that maneuver.
Okay.
When a company issues over $1 billion in brand new stock, they are materially diluting the proportional ownership of every single existing shareholder.
The pie just got significantly larger, which means everyone's slice just got thinner.
Exactly. Doesn't utilizing massive shareholder dilution to go on a billion-dollar global shopping spree severely compress their near-term earnings metrics and anger the institutional base?
It absolutely causes temporary EPS dilution. The net income is now divided by a significantly larger pool of outstanding shares.
Right.
However, you have to contrast that deliberate equity dilution against the pristine defensive posture of their baseline financial health. You cannot look at the equity raise in a vacuum.
If we go back to the Q1 2026 audit, before these massive acquisitions fully integrated into the financials, MDA was sitting on an incredibly strong net cash position of 299 million Canadian dollars.
They were operating with a defensive negative 0.9 times net debt to EBITDA ratio.
For the financial models, a negative net debt ratio means they literally held more liquid cash and equivalents on their balance sheet than their total outstanding debt obligations.
They had absolute financial flexibility.
Precisely. By utilizing the newly minted equity capital to fund the purchase of BCT and CLS, they protected that pristine baseline.
They avoided loading high-yield corporate debt onto the balance sheet, and the strategic genius of the specific targets they chose is revealed in the margin profiles.
BCT and CLS are not distressed, cash-burning startups that require turnaround capital. They are mature, highly profitable entities generating their own independent, robust free cash flows.
The sources explicitly state that both acquired companies operate with structural EBITDA margins hovering in the 18% to 20% range.
If you recall our dissection of MDA's Q1 operational audit, their standalone baseline EBITDA margin was 19.5%.
This is why the financial math is so elegant, because the margins of the acquired targets perfectly mirror the margins of the parent company. Integrating these massive new divisions does not drag down the overall profitability metrics of the enterprise.
It is a perfectly accretive maneuver.
Management's forward-looking models calculate that once the deals officially close and the financials are consolidated, their pro forma leverage, their projected debt ratio incorporating the operations of the new subsidiaries, will remain safely entrenched inside their strict target ceiling of 1.5 times to 2.5 times net leverage.
They successfully engineered a billion-dollar global expansion, captured critical footholds in the most lucrative sovereign defense markets on Earth, doubled their recurring SaaS revenue, and managed to do it all without ever betting the farm or breaching their internal leverage constraints.
It is a masterclass in aggressive yet disciplined capital allocation.
They took the dilution hit exactly once, completely insulated their credit profile, and now, as the corporate presentations state, as they pivot into fiscal 2027, the strategic focus shifts entirely away from capital raising.
The dilution phase is over. The focus transitions purely into compounding cash flow as the Montreal factory hits peak operational capacity and Telesat Lightspeed hardware begins rolling off the line.
It is the architectural definition of a cycle-resistant compounding machine. They utilize relatively expensive equity to purchase cash-flowing, highly strategic assets that immediately expand their global moat.
Which brings us to the ultimate synthesis of this deep dive.
Bringing all these massive interconnected threads together, the two-a-day automated satellite assembly line of Montreal, the bulletproof legal contracts that completely shielded them from the $1.8 billion EchoStar fallout, the global M&A sweeping up sovereign AI data streams and classified U.S. hardware footprints, and the pristine equity-funded balance sheet. What is the final verdict for the listener?
How do we contextualize MDA space within the broader, highly volatile orbital economy?
To deliver an accurate final verdict, we must contrast MDA space against the loudest, most dominant alternative in the aerospace sector, SpaceX.
Currently, SpaceX functions as the ultimate monopoly infrastructure provider.
They control the launch market, orbiting roughly 80% of the world's payload mass, and they operate the largest commercial telecommunications constellation in existence with Starlink.
However, from a strict valuation and investment standpoint, the models driving SpaceX and similar highly hyped launch infrastructure companies are priced for absolute perfection.
They're trading at extreme, almost incomprehensible multiples. The private market valuations and proposed IPO models for these launch monopolies sometimes push toward 94 times sales.
That is nosebleed territory. A 94 times sales multiple essentially demands that the company completely monopolize the entire space economy, flawlessly execute every technical hurdle, and face zero regulatory pushback for the next century.
It prices in zero margin for error.
The verdict derived from the sources is that MDA space represents a fundamentally superior, cycle-resistant structural value play.
At their current, substantially more compressed market multiples, MDA offers an operational compounding engine backed by tangible, fully funded reality.
They possess a non-speculative, legally binding $3.7 billion firm contract backlog.
Beyond that, they are actively targeting a massive $40 billion broader opportunity pipeline.
They aren't relying on speculative hype regarding Martian colonization to justify their valuation.
The revenue is anchored to fully funded sovereign military budgets, massive commercial broadband deployments like Telesat, and recurring global maritime data subscriptions.
This leads us back to the overarching summary analogy. The market must stop viewing MDA through the outdated lens of a legacy robotics component manufacturer.
They are the unassailable, vertically integrated mass. If the U.S. Space Force requires an orbital defense platform like MDA Midnight to actively guard its multi-billion-dollar assets against kinetic interference, MDA pulls the commercial bus off the line, mates it with Canadarm-derived robotics, and delivers it faster than any legacy prime contractor on Earth.
They are the ultimate picks and shovels of the new space age.
They own the factory that builds the hardware, they own the custom silicon that directs the signals, and through CLS, they own the artificial intelligence networks that process the resulting data down on Earth.
But to maintain the analytical rigor you expect from Graphonomics, we cannot simply present a flawlessly optimistic scenario.
No, there's immense friction in scaling heavy industry. Based on the mid-2026 sources, there are three primary execution risks moving forward that any serious observer must continuously monitor.
The first and most immediate is a continuation of near-term free cash flow compression.
As we dissected earlier, the massive capex required to finalize and fully tool the Montreal factory will continue to drag on cash flows.
Management expects this metric to track neutral to slightly negative through the entirety of full year 2026.
The factory must be completely finalized and fully operational before the compounding cash flow phase can truly begin. The capital squeeze will persist for several more quarters.
The second massive execution risk revolves around technical supply chain delivery lags.
MDA is managing incredibly complex payload configurations.
They are attempting to integrate highly advanced custom radiation-hardened Prime 2.0 digital beamforming chips, sophisticated robotic grappling arms, and complex power systems on an automated assembly line moving at a pace of 2 units per day.
In the aerospace sector, you cannot simply issue an over-the-air software patch if a physical component fails in orbit. Quality control must remain absolute even as velocity increases exponentially.
Any localized hiccup in the global raw materials supply chain or a single recurring flaw discovered during mass assembly integration could trigger massive delivery delays,
triggering punitive contractual penalties and delaying milestone payments on billion-dollar programs like Lightspeed.
And the third, potentially most disruptive risk, is completely out of the engineer's hands. multi-jurisdictional regulatory approvals.
MDA has legally agreed to acquire BCT in the United States and CLS in France.
But to successfully clear these highly sensitive cross-border defense transactions, they must navigate incredibly complex, highly politicized bureaucratic approvals.
The acquisition of BCT must clear the Committee on Foreign Investment in the United States, or CFI-US.
While the CLS takeover requires equivalent national security reviews by the French government.
In an era of increasing global protectionism, there is always a non-zero risk that regulators balk at allowing a foreign entity, even an allied Canadian one, to take majority control of critical national security infrastructure.
If regulatory approval is denied, the entire sovereign M&A strategy instantly stalls.
Those are structural, existential hurdles. But if MDA successfully navigates the regulatory labyrinth, perfects the supply chain, and pushes the Montreal facility to maximum capacity, the resulting upside is fundamentally transformative.
Which leaves us with a final provocative thought for you to mull over.
As we've seen throughout this entire analysis, we are watching the emergence of an entirely new kind of corporate power structure.
Companies like MDA Space are achieving the ability to mass-produce advanced orbital defense platforms like Midnight, completely bypassing the bespoke timelines of national militaries.
Through entities like CLS, they are actively ingesting and monopolizing the sovereign AI data streams that track the entire globe's maritime movements.
They are rapidly building the physical and digital neural network of low Earth orbit.
It forces a massive geopolitical reevaluation.
Oh, exactly.
So as we look to the future of this domain, are we rapidly accelerating toward an era where vertically integrated multinational aerospace corporations hold more functional day-to-day operational power over the space domain than the individual sovereign nations that are funding them?
When one single corporate entity controls the automated physical assembly lines, the advanced orbital defense robotics, the custom communications silicon, and the global ground-based data analytics, who actually controls the ultimate high ground.
Something to think about tonight as you look up at the night sky.